Question 8, we are going to focus on dividend capacity. We are going to work on the agency issues, the agency problem, and the solutions, right? So, before we read the case study, let's go to the requirement. Part A, estimate the company's forecast dividend capacity for a normal year. So, we have to focus the dividend. We have to focus the dividend capacity, right? Make sure that you know how to calculate dividend capacity. Next, we have estimate the level of dividend required from Bower Scout Company to give Arthuro Company significant dividend capacity to maintain its dividend level of 0.74 per equity share. So what is the dividend required from a subsidiary to the parent company so that there's a sufficient dividend capacity to maintain, which is 0.74 per equity share. Next, we have part B. The company has decided to increase its level of dividend from Bower Scout Company if its dividend capacity is insufficient, right? So in this case, we have to talk about the parent company, right? This is the parent company. Viewpoint discuss the financial benefits of and problems with this decision. Which decision? The decision of increasing the dividend from your subsidiary companies. What are the benefits and what could be the problem for the parent company? Next, we have discussed the agency problems and how they might be resolved with this decision. So we need to talk about the agency problems and solution. Now let's go to the case study. Arthuro Company is based in Hittiland and is listed in Hittiland's stock exchange. The company has one wholly owned subsidiary, Bower Scout Company, based in the neighboring country of Ovalia. Hittiland and Ovalia are in a currency union and the currency of both countries are in dollar. Arthuro Company purchased 100% of Bower Scout Company's share capital 3 years ago. Right? So Arthuro Company has the power under the accusation to determine the level of dividend paid by the subsidiary company. However, the parent company decided to let subsidiaries management team have some discretion when making investment decisions. Okay, so the company's board decided that it should receive dividends of 60% of the subsidiary's post-tax profit. This is the dividend which the parent company is going to receive. 60% of the subsidiaries post-tax profit and has allowed to the subsidiary company. I'm going to refer to parent and subsidiary. So Bower Scout is the subsidiary company and Arturo Company is the parent company. So the subsidiary company, it has allowed the subsidiary company to use its remaining retained earnings. The earnings which they are not, the post-tax profits which they are not going to give as a dividend, right? Which they are going to retain. They can use it to fund investments chosen by its management. Okay, so a bonus is linked to the subsidiary company's after-tax profit and is a significant element of the subsidiary's manager's remuneration. So bonus is linked to after-tax profit for the manager's remuneration. Okay, and the subsidiary company operates in a very competitive environment. Recently, a senior member of his management team has left to join a competitor. Now we are going to read about the parent company's dividend policy. Until 3 months ago, the company has 90 million $2 equity shares in issue and 135 million 8% bond. So this is for equity, this is for the bond. The debt. And 3 months ago, it made a 1-for-3 right issue. A number of shareholders did not take up their right and sold, so that there has been changes in shareholders base. Some shareholders expressed concern about dilution of their dividend income as a result of the right issue. Therefore, the parent company's board felt it had to promise for the foreseeable future at least to maintain a dividend of, right? Because they are worried because of this right issue. Now what happened was the parent company is concerned what will happen if they don't receive enough dividend. So in order to maintain that, right, they had made a promise that for the foreseeable future they have to maintain a dividend of 0.74 per equity share, which is paid for the 2 years before the right issue. So the parent company's board is nevertheless concerned about whether it will have sufficient funds available to fulfill its promise about the dividend, right? If you have to pay a dividend, you should have sufficient funds so that from that fund you can pay the dividend. So now the board is worried about that, whether they will have the sufficient fund or not. It has asked the finance director to forecast its dividend capacity. Based on assumptions about what will happen in a normal year, the finance director has made the following assumptions in the forecast. Please go through the assumptions. This is very important because from here you have to do your calculation. What is the how much dividend is required from the subsidiary to the parent company so that they can maintain the 0.74 per equity share. So it's very important that you understand this piece of information, the assumptions by the finance directors. Because your calculation part, you need all this information, right? So sales revenue can be assumed to be 4% greater than the most recent years of 520 million. Operating profit margin can be assumed to be 20%. So operating profit margin is 20%. Operating profit. Number 3, operating profit can be assumed to be reported after charging depreciation of 30 million and profit on disposal of non-current asset. So profit is 5.9 and depreciation is 30 million. Right? After they have deducted, they have got this operating profit. So what they meant to say is the reporting profit, operating profit which they got is after they deduct depreciation and added the profit on disposal. So the cost of the non-current assets sold can be assumed to be 35 million. This is the selling value of the non-current asset, and the accumulated depreciation for that disposal part is 24.6 million. Depreciation is allowable for tax and the profit on disposal is fully chargeable to tax. Now let's go to part 4. Okay. The net book value of non-current assets at the year end in the most recent account was 10 million. To maintain the productive capacity, sufficient investment to increase this net book value figure 12 months later by 4% should be assumed. 4% you are going to increase this. And this 4%, if you see even your sales, in the first one you are seeing that sales is also increasing by 4%. So it is in line with the increase in sales. The calculation of investment required. Now read this part very carefully because this is where most of you go wrong, and like when you calculate you don't understand. You misinterpret the requirements. They are saying the calculation of investment required for the year, right? So your book value, net book value current is 110 and it will be increased by 4%, right? You have to find out what is the additional investment, right? So to calculate that additional investment, you have to take into account the depreciation which was charged, right? Should take into account the depreciation charged 30 million and the net book value of non-current assets disposed. This also you have to take into account before you take the additional investment. Fifth one, a 0.15 investment in working capital can be assumed for every $1 increase in sales revenue. So 0.5 for working capital for every $1 increase in sales. Last, the subsidiary company's pre-tax profits can be assumed to be 45 million. This is the subsidiary company. Okay. Now, the parent company's directors have decided that if there is a shortfall of dividend capacity, what are they going to do? Compared with the dividends required to maintain the current dividend level, the percentage of the post-tax profits of the subsidiary company pays as dividend should increase if necessary up to 100%. What does it mean? It means that the dividends which you are going to take from your subsidiary, in case if your dividend capacity is short, you're not able to maintain that 0.74 dividend per equity share, you are going to increase your dividend from your subsidiary up to 100% if necessary. That's what it means. Now let's go to the taxation part, right? So the parent pays corporation tax at 30%, okay, and the subsidiary pays corporation tax at 20%. A withholding tax of 5%. So there's a withholding tax of 5%. It is deducted from any dividends remitted by the subsidiary. There is a bilateral tax treaty between the Hittiland and the Ovalia. The corporation tax is payable by the parent company on profits declared by the taxes payable by on profits declared by the subsidiary. But Hittiland gives full credit for the corporation tax already paid in over a year. So Hittiland gives no credit for the withholding tax paid on dividends, and so there is no credit for withholding tax. That 5%, there is no withholding credit for that. You will only get credit for the tax on the profits of the subsidiary. That means here parent is paying 30%, but in subsidiary it is 20%. So if you have paid there 20%, here you only have to pay 10%. That's what it means. So now we have to estimate what is the dividend capacity for a normal year. To estimate that, okay, let's go through this. So this is how you start, right? This is basically your free cash flow to equity method, because they are talking about whenever it's a dividend capacity which you have to focus, you have to use this model. Free cash flow to equity, something to do with equity, right? Equity and dividend, they are linked. You pay equity shareholders dividends, you pay ordinary shareholders dividends, right? So if it is free cash flow to equity, FCFE has to be there. That this E decides whether there is a dividend capacity or not. If that E is not there, you cannot focus dividend capacity for that. FCF, this is FCFE. So if you see the formula also, the method also, the way it's doing, that's very similar to FCFE only. You start with operating profit. You start with operating profit. So this is your number one thing, operating profit. What was your operating profit? It is 20% of your sales revenue. So your sale is increasing by 4%. That's why it is 1.04 into 520 sales revenue. On that you are taking 20%, that is your operating profit. Less interest. How you are getting your interest? It has been told that the bond is 135 with 8%. So that bond, right, on that bond you have paying interest 8% on top of 35. Deduct it. Interest needs to be deducted, right, in free cash flow to equity. Now let's go to tax. Tax is 30% on what? Operating profit minus your interest tax, and it's 30%, right, in the parent company. Add depreciation. Your depreciation, remember, it's a non-cash flow item. You want to find cash, right? Focus dividend capacity is basically you find cash, because you have to pay from cash only, you have to pay dividend, not from profit. So you have to add back that depreciation which has been deducted to get the profit. Now add that back to get cash flow. So add depreciation 30,000 less profit needs to be deducted. Profit has been given to you as 5,900, right? Profit on disposal of, that's right, it is a non-cash item. It needs to be deducted because it was added when the profit was calculated. So all this adjustments you need to know, what needs to be added, what needs to be deducted to find cash. From profit to cash you need to know. You have to be mastered at this by now. Add cash received on disposal. Please see there's a working for that. When you're disposing, of course you're receiving cash. What is that cash? How much? You need to do a separate working. We'll see that. Less investment in new non-current assets. For this also there is a working too. This is how you are going to present your main answer. You're not presenting you're not doing all the workings in your main table. Workings you're keeping separate. Your working should always be separate, and this is in thousands, right? Less investment in working capital, right? So investment is easy. They have told that 0.15, that means 15% for 1%, for $1 increase in sales revenue. So sale has been increasing by 4%. That's why it is 0.04 into 520, right, the revenue. So that is your working capital. Less. Add the dividend remittance from the subsidiary. How much dividend you are getting from the subsidiary company? For that we have working 3 that needs to be added, because your parent company is receiving dividend. For that there are 3 different workings. And finally the tax, additional tax. What was the pre-tax profit of the subsidiary of the Bower Scout company? That was 45 million. What is the additional tax you have to pay? 10% only, because on that you have paid 20%, but now you have to pay 10%, because 30% is paid by parent, 20% is the subsidiary. So the difference is 10%. That difference you have to pay, because you paid less. You paid 20%, but you have to pay 10%. So 10% on 45 and it will be deducted, and this will be your forecast dividend capacity. So now let's go to the 3 working and see what it is. How much cash received, right? So cash received, you start profit, right? You add your profit and your cost, how much you sold your non-current asset for 35,000, and add your profit with that, deduct your depreciation. Your accumulated depreciation on your disposal was 24,600. So this, the balance is your cash received. This you will be added, right? Just check here. It is 16,300. It is added because it is cash received. Now let's go to the second one. How much you are investing in non-current assets. Investment in non-current assets, that is your investing activities. It needs to be deducted because from your cash only you are investing in non-current assets. So your net book value was 110. You're deducting your depreciation from that because they told that take into account depreciation when you're calculating the investment in non-current assets. So it needs to be deducted. From here you need to deduct your net book value of assets disposed. How much it is being disposed, right? So 35 million is the selling price, and also out of that depreciation you're taking out. So it is 10,400. Then you have 69,600, right? And the required level of non-current asset, it will increase by 4%. 4% on what? On 110, on this 110. All this we have done because they have told that you need to take into account this one and this one. That's why we need to deduct it from 110. So, and you have to increase it by 4%, right? So 110 in this year, in the last year, it was 110 million non-current asset. It will be increased by 4%. So that's why it is 110 into 1.04. Just check the difference between this and this. How much it has been increased from 69.6 to 114.4. How much it increased, right? So you can just find the difference between two, the required level and this, and the difference is your investment in non-current assets. So this much you are investing, so that it increases up to 114.4, and this needs to be deducted. So you're deducting here 44,800. Next is your remittance. How much you're taking remittance from your subsidiary, right? It's here. So dividends, remittance, just see you have to put different subheadings for different requirements. So it start with profit before tax. Profit for Bower Scott was 45,000 profit before tax. On that you are taking 20%. This is the Bower Scott's tax. Deduct it. Profit after tax is 36, right? Out of this, how much you are remitting? All the 60%. And you also have to take the withholding tax. That withholding tax 5% is to be deducted. That's why it is 0.95. So this is the amount you have to send to the parent company by the subsidiary, and this needs to be added to the parent company here, right? So finally you are getting this focused dividend capacity. That's what you were supposed to calculate. Now let's do in the second one. Second one, you have to see how much increased, how much it needs to be increased, the dividend, right? Let's go to the second requirement again. So the second requirement asks is for 3 marks, right? So estimate the level of dividend required from the Bower score to give Arthuro company sufficient dividend capacity to maintain its dividend level of 0.74. So to maintain that, how much dividend should be increased to maintain that 0.74? We all know that it was 90, right? 94.2. Let's read here, right here. Here, $90 million to equity shares in issue. And there has been a right issue 143 right issue, and it has been paid for 2 years before the right issue. So when you're taking it, it should be like this: 90 143. So divide by 3 into 2, because $2 per equity share, and then for 2 years. So that's why it is 90 divided by 3 into 4, as you can see here, into 0.74, because per equity share. So it is this 88.8 million, right? So what is the current dividend remittance? Just now we calculated it, 76.652. This needs to be deducted from this new dividend capacity, and it is 12.128. So how much total dividend remittance required? add, right, this with this one is this, the increased amount, and this 20.52 is how much it has been remitted to the parent company. 20.52 plus the increased amount. This, the whole thing needs to be grossed up. It is to be divided by what? Divided by 0.95, divided by the withholding tax. Because withholding tax is 5%, so it needs to be divided by 0.95. So this will be your total dividends required. This. And the distribution percentage required, if you want to find in a percentage wise, it is this divided by 36. You are getting 95.5%. They told if it's needed, they can increase the dividend up to 100% also from the subsidiary, like dividend remittance. But here it is 95.5%. So 95.5% of the profit after tax from the subsidiary is going to the parent company as dividends. Why 36 million? Why here it is 36 million? Because this profit after tax, right? Basically, how much dividend you are paying from the profit after tax. So now we have to say what are the benefits of this policy and what are the drawbacks of this policy. Which policy? This dividend increased to 95.5%. We'll see what are the benefits. So the benefits is the change of the policy appears to be viable. How? We'll see. Arthuro company would have had some slack if it had not undertaken the right issue. So the new policy takes up this slack and effectively tops up the amount required with an increase in dividends. Right? The new policy appears to ensure that the parent company will have sufficient funds to pay the required level of dividends. Yes, exactly. What happens because of this new policy? Since you are getting sufficient dividend from the subsidiary company, now the parent company will have sufficient funds to pay that dividend and fulfill its own investment requirements. It will mean that the subsidiary company will have less retained funds available for investment. See, what happens is the subsidiary company is paying 95.5% out of its profit after tax as a dividend to parent company. So how much is remaining with the subsidiary? Very less, very less. So they cannot retain that much. So since they cannot retain that much, they will not have that much of funds available for investment, right? But the parent company's investment opportunities may be more profitable. So that could be an advantage and also a disadvantage for the subsidiary. Now let's go to the, but we have to talk from the parent company's point of view. That's why it's an advantage. Now let's go to the problem with the policy. So Arthuro company is now close to taking all of the Bower Scott's company's post-tax earnings as dividends. As you see, 95.95%. It's not a small amount, it's a very significant amount. Profit after this much profit after tax earnings they are taking as dividends, the parent company. So only a limited fall in the power company's earnings would be needed for its dividend not to be enough to sustain the parent company's dividend level, right? What does it mean is that even if the earnings fall by a very little amount, that means the subsidiary will not have enough dividend to pay the parent company. So the parent company will suffer. Their dividend level will go down. They will, right? Because they're dependent on the subsidiary, right? So if subsidiary cannot pay the dividend, parent company will suffer. They also cannot pay their dividend. So a fall could easily happen. See, this fall can easily happen. Given the highly competitive environment, just see how they're linking. In the beginning of the case study, they told that the subsidiary company, which is the Bowers Scott's company, is in a very highly competitive environment. So when you're in a highly competitive environment, your earnings can change, right? Your earnings can fall easily. It's easy for your earnings to fall. So in which the subsidiary operates. So if the parent company wanted to increase its dividend over time, it could not do so by receiving extra dividends, right? Because parent company is dependent on subsidiary. So if subsidiary cannot pay that dividend to parent company, right, then it will not be a sustainable plan. This policy will not be sustainable. Now, as mentioned, an increase in dividend will leave the subsidiary company management with less retained earnings to invest. The amount of investment they can undertake with the reduced funds available may be insufficient to sustain earning level and hence dividends for the company, the parent company, right? So even if that with that limited fund which is there for the subsidiary, if they take some investment, still that investment will not be enough to get a sufficient amount of earnings, and hence dividend will suffer, right? Always you need to talk about this tax regime when you're talking about dividend capacity, and it's when it's in two different companies, right? Here the parent and the subsidiary are in two different companies, and the tax rates you see are two different tax rates. Parent is paying 30%, subsidiary is paying 20%, and withholding tax is 5%. That you can, that there's no credit for that, so you need to talk about all these points. So the tax regime between the two countries means that the group will suffer more tax, right? As a group, you're suffering more tax. The amount of additional tax payable by the parent on the subsidiary's profit will remain unchanged, right? You see that we had to pay 10% tax, but the increase in dividends will mean an increase in withholding tax. See, now you're increasing that dividend from the subsidiary. Parent company is receiving the dividend which they are receiving from subsidiary. What happens? Withholding tax will increase 5%, for which the parent will receive no credit. There's no credit for withholding tax given the lower tax rate in overlay. So who is having a lower tax rate? Subsidiary company's country, 20%. So for tax purposes, high retained earnings for the subsidiary companies would be preferable, right? Why? It's better to keep keep it as earnings retained. Retain your earnings rather than distributing it as dividends to your parent company. Why? Because you have to pay higher tax. If you look in the perspective of the tax, from the tax point of view, it's better to retain for the subsidiary companies rather than paying it as dividends, possibly with funds loaned to the parent company rather than paid as dividends. If you pay as a loan, you don't have to pay tax, but if you give a dividend, you have to pay a tax. Now let's go to the agency problems and what are the solutions, right? So an agency situation arises between the parent company's board, the principal, and the subsidiary company's management, the agent. The proposals are likely to involve agency cost. We'll see how. The policy limits the discretion of the subsidiary company's management by restricting the amount of retained funds available. See now, because you are paying 95.5% as a dividend to parent company, subsidiary company does not have enough retained funds, right? So they don't have that much of choice, right? It is restricted. They are restricted. Their management is restricted to go for any investment. So these are some agency problems, right? However, this is an inefficient way of exercising closer control. If a parent company, like if the principal wants to exercise an closer control for the agent, this is not a good way. This is an inefficient way. With agency cost including the increased liability for withholding tax, right? If the parent company's board has concerns about the subsidiary company's management, it would be better to make changes in the management team. Even if the parent company's board has confidence in the subsidiary company's management team, it may nevertheless wish to oversee the subsidiary more closely given the dependence of its dividend capacity on the amount received from the subsidiary. Again, increased supervision will involve increased agency costs in terms of time spent by the parent company's management. And so the subsidiary company's management may feel that the new policy threatens their remuneration, as the limited funds available for investment will adversely affect the company's ability to maintain its profit level, right? If they're having limited funds, the subsidiary company is having limited funds for investment, what happens is it can affect the company's ability to maintain its profit level. So, and if it's not able to maintain the company's profit level, what happens as a result? Subsidiary company, their manager will not be paid remuneration, so their remuneration will suffer because of this policy. So the managers may seek to join competitors, disrupting the subsidiary company's management, jeopardizing its ability to achieve its profit forecast. Now, how we are going to resolve this agency problem? We told that these are the problems, but also there needs to be some solution for each problem. So the ways of motivating the subsidiary companies management include making their remuneration less dependent on the subsidiary company's results. For example, allowing them share options in the parent company. If more of their remuneration depends on the group's result, the subsidiary company's management may be happier with the suggested arrangement if they feel it will benefit the group. However, this motivational effect will be limited if the subsidiary company's management feels that the group results are not influenced much by what they do. Right? They have to be convinced. Right? Who? Subsidiary companies has to be convinced by the parent company that because of the subsidiary company, right, they have an influence on the group result. Then only they will feel motivated. So all these are agency issues and all this you should be able to, these are like general. You should know what can motivate and subsidiary, what could be demotivating, how you can motivate, and all those things. Okay. So alternatively, a greater proportion of the subsidiary company's management's remuneration could be by methods which are not dependent on its results. So now they are talking about remuneration package. How they have to link remuneration with results, how they should not link. Okay, for example, increase salary or better benefit. So they are saying if you increase their salary or better benefit would be better. However, by weakening the link between results and remuneration, it lessens their incentive to strive to produce the results needed to maintain the required level of dividend. The decision making on investment at group level may also have to change. Subsidiary will have under the new policy have insufficient funds. See, because of this new policy, which policy? Paying their 95.5% of their income as a dividend to parent. So the subsidiary will be left with nothing. They will have insufficient funds for major investments. Its management team should have the opportunity to make a case for retaining a greater percentage of funds. So the subsidiary company's management should say, they should have a say that no, we are not going to pay you dividend, this much of dividend. We are going to retain a greater percentage of fund, as they may have a better investment opportunity than those available to the parent. Right? So this is all about parent and subsidiary, how this policy is going to affect one and how it's going to benefit one. That's all you have to know. Right? All this, even without studying, you will be able to tell. Right? Because these are common sense. So these are some general points which you can come up easily on the exam if you read the case study properly and understood. So that's it for this, and the next question will be I'll be solving is question 9. It is also something very related to this. So make sure that you go through this question and practice, 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 because practice makes a man perfect. Meanwhile, don't forget to subscribe to this channel, and thank you and take care.